Hi, welcome to my channel, Money Madeline. I'm here to teach you a lesson today on capital gains and what it means and how it affects any transaction, any purchase of a home that you purchased, whether you bought it for your principal residence or whether you bought it as an investment property, or a fix and flip, or whatever you bought it for, the purpose of your purchase. Okay, so capital gains are profits that you make when you sell a property for more than you paid for it. So you get the purchase price. If you made any improvements, any commissions you paid, any closing costs, you subtract all that, and what you have left over is called capital gains. So in many countries, selling your primary residence may qualify for tax exclusion, which means you may owe no capital gains. That typically isn't what happens once you already have owned the home over a year. If it was your primary residence and you lived in it at least 2 of the last 5 years, you haven't used the exclusion recently. You may exclude up to $250,000 gain for a single file, and $500,000 if you're filing jointly. If your gain is below these limits, you generally will not owe any capital gains. So, when do they apply? If the home was not your primary residence, so you either use it as a rental, an investment, or a second home. If you do not meet the timeline requirements, if your gain exceeds your exclusion limits, and if the property was used partially for a business. There's different types of capital gains. There's short-term capital gains, which are for properties used less than a year. It's usually taxed as ordinary income. And then you have long-term capital gains, which is anything over a year. Is typically taxed at a lower rate. The rates are pretty high. I would say, if I'm not mistaken, it is about 15%. What reduces taxable capital gains? You could reduce it by subtracting, which are any improvements that you made, any commissions, any closing costs, and legal fees that apply to money that you have spent in acquiring this home. So if you bought a home, for example, $300,000, you sold it for $500,000, but you made qualified expenses, upgrades to the home, you've paid commissions to realtors, and you put it back on the market, and you spent $40,000 doing that. That will be, you paid $500 minus the $300,000 minus the $40,000. So your capital gain is $160,000. On that $160,000, which is the capital gain, you will be required to pay taxes on. So basically the points of all this, you definitely should know about this if you're investing in homes, whether it's a fix and flip, whether it's your primary residence. You are responsible to pay the capital gains each and every time a sale is transferred from one owner to the next. It is very important in knowing this when you fix and flip, to know that you are not gaining all of the income that you think you're gaining on that investment. You actually have to pay the government taxes on that investment and your gains. So for all of you that don't know about capital gains, I hope I was able to explain it. Let me know below if you have any questions in particular about this. I will be doing many more topics this week. I am planning to do a video every day. If you have any questions, I also want to throw out a Spanish speaking video on a lot of the primary subjects that I discussed with you. May you all have a blessed, wonderful day. I'm going to get back to work, but that was capital gains and a short explanation of what it means and how much you are going to owe.